Hi everybody, this is the investing teacher, high school science teacher, teaching others how to invest. Before we start, I want to show the quote on the board. Got to move my head a little bit here. To not practice would be practice malpractice. Get it? Practice malpractice. Bad lawyer joke there. Anyway, this strategy that we're going to go over today, I would recommend practicing it a little bit first just to see the risk return. It's a little bit more advanced than the other strategies I've been doing on this channel. So if you're a new person, new subscriber, feel free to click that like, subscribe button, helps out. And check out any of my older videos where I go over a lot of different strategies on credit spreads, cash secured puts, and whatnot. So we're going to be looking at the fairly famous 1-1-1 strategy. I didn't invent this or anything, but just like to see the risk profile on this one. We're going to look at the Analyze tab on Thinkorswim, how to set up these trades initially, and different strategies to use, how to exit out of them, and possibly use them as hedges and whatnot. So let's just get right to it. Alright, so this trade is called the 1-1-1 trade. Essentially the first two ones, you're going to be buying a put debit spread. So that's going to be a debit, that means you actually have to pay for it. But data traders over here, we like to have net credits because we're trying to use theta to decay. And the last one, we're going to be essentially selling a naked put much lower in strike price than what the put debit spread is. And the premium received on that naked put that we're selling will be greater than the put debit spread. So when you're starting out the trade, you'll have a net credit. It's going to be a little bit smaller, obviously, because your put debit spread's a little bit costly. And then what's good about this is you have a pretty good risk return profile. There's a good hedge there in case, in this case we're using MES for the futures market. If it drops a little bit and around half to near the end of expiration, you can still actually show a very big profit on these. The one thing that you got to be careful on is if it drops immediately, you're still going to be pretty far behind. And we're going to look at that in the Analyze tab. So let's look at Thinkorswim and how to actually set up this trade, and the trade that I actually just started yesterday on. May the 4th be with us all. Okay, so here's how you set up this strategy. I'm going to do this on /MES. It's the mini futures for the S&P 500. I tend to look around 26 to 60 days or so. We're going to do the 56-day strike. I'm doing this video on May the 5th, so that'll be 56 days later in middle of June. Essentially, you want to be doing a put debit spread, not a credit spread. And we tend to look around 0.25 or so delta. Let's look at the 4,000 strike price. And we're going to buy that option or future contract. And then you want to sell the contract at about 50 below that. So 4,000 minus 50 is about 39.50. And we're going to sell that contract. And we'll just do one of each. Typically, I like to see the debit at around minus 10 or so for this. Right now, the midpoint is around negative 9.25. That should still be pretty adequate. Let's see if we go from 40.50 to 4,000. It's a little bit higher, 1,100 or so. So somewhere in the middle should be pretty adequate, maybe around 40.30, so 39.80 give or take. Here we see the mid around 10.25. And we might try to go for a debit around 10. Now, MES has a 5x multiplier, so you're essentially down 10 times 5 or $50 on this particular trade if you enter it. It doesn't mean you're going to necessarily lose all that at expiration, but we want to find a way to actually make this a net credit. So what we're going to do is try to find a strike price at a low enough delta where it's still safe, and it's going to pay about a $20 or 20-point credit in this case. So if we look around the 3,500s or so, right at 3,500, the bid's 19, the ask is 21, there has been a little bit of volume. So I'm going to try to sell this 3,500 on top of the put debit spread. So 3,500. You'll see the bid and ask. We're going to try to go for a credit. You say -10. And that's pretty close to the mid price. The mid is at -950. So if you do -950, you still possibly will get filled on this. And then 5x multiplier, you're looking at about a $45 or so net credit on your account when you place the trade. Okay? So here was the trade that I actually posted and did last night. And the trade was, let's look at the numbers here. So essentially bought a 4050 put. I sold a 4,000 put. That makes it a put debit spread. And then I sold a 3550 put. The net credit was 1025. Times that by 5, and you get a little over $50 after commissions. If we end up closing this trade, it'll end up being about a $44.50 net credit. Now, this is the Analyze tab, and we'll look in real time shortly on what happens as you get closer to expiration on this. But entering the trade, you're going to be receiving about $44.50 on this. And that's the green line I'm looking at. This is the expiration date. If it goes a little bit below that 40.50 bought put at expiration, it starts to trend upward a little bit because that put debit spread will have some value at expiration. If it happens to go to the 4,000 strike price, that's the sold put, anything from 4,000 all the way to where we sold our put would be the max profit on this case. The reason why is the put debit spread would be at max profit, while the sold put that we did at 35.50 or so would be expiring worthless, and you'd be able to keep all that credit. And as you can see, the net profit is very high on this trade. You can make $294.50 if MES closes between 35.50 or so all the way to 4,000. Now, if you look at the strike prices for that right now, about 3,500 strike, we're looking at a 0.07 delta all the way to the 4,000 strike. The 4,000 strike, we're at a 0.26 delta. So there's a fairly decent chance that MES might close between these numbers. Okay. Now, we actually don't mind if it doesn't close between these numbers. Let's say MES keeps going upward and it closes somewhere over here at expiration. And notice right now MES is at 42.60 and change at around 4,100, which is slightly lower than current price. You're still going to collect that 44.50. So we don't mind at all if MES happens to go up or stays around where it is because we have a net credit. If MES happens to drop a little bit near that 0.25 delta all the way to around a 0.07 delta, which is a pretty decent range, by the way, you would get an even bigger profit of $294.50. Notice how the buying power to start this trade was $465. Your margin requirements due to span margin can change as it moves. So I'd recommend holding at least double this in cash. So you want to hold at least an extra $500 in cash that you're not going to trade, just so you could deal with span margin as it moves. Okay. Okay, next let's look at the Analyze tab on Thinkorswim. The way to put this in your Analyze tab is once you have your order entry in place, right-click on your mouse and click Analyze Trade. And then if you go to the Analyze tab, under the risk profile, you will see the possible returns at different strike prices. Now again, the green line here is the actual expiration, what profits you could get. As I'm moving this cursor on the bottom here, you see the different strike price, the different prices for MES at expiration. On the bottom left here, and it's a little hard to see, the green line would show the net profit or loss. So if we go over here, I'm going to include commissions on this. The net profit right now, again, I'm doing this video in the morning after the trade was placed. The profit right here is at, down here, $293.25. My profit all the way over here, if you look down here, would be $43.25. So a good initial credit that you can receive by doing this trade if you decide to do this today. Now I'm going to click on the 0 point on my mouse, and you're going to see right at 3,500, that's where I'm a little lower than where I'm selling my 35.50 put, is where I would have my break even. Okay? It's actually slightly lower, about 34.91 or so. If MES happens to be right at this price, I would break even on the trade. The reason why this happens is you do receive a lot of credit on the put debit side, but the short naked 35.50 put would be losing a little bit of money if it went down to 34.91. So what's neat about this trade is it actually lowers your break even compared to just selling a 35.50 put. It makes it a little bit safer in the trade than just selling a 0.07 delta put. The 34.91 strike, if we look at that particular strike, which is a little lower than 35.50, 34.90 or so strike, still says 0.07 delta. When I made the trade, it was around 0.07 delta. Right now it's 0.08 delta, and that's because MES is dropping it open. So it's about 0.01 delta less, slightly safer than just selling the naked put. Okay. Now back to the Analyze tab. This purple line represents the profit and loss at a certain date that we put here. This is today. If MES happens to absolutely plummet and go to around 4,000 today, we would actually be at a loss today. Down here it said about negative $110 or so. Current price right now is $42.60. So $42.60 is around here. We're pretty much at break even right now. Okay. What's neat about this is if you could change the date and see what the approximate price of this whole contract, whole options would be as you go in the future. So I'm going to move this date up and watch what happens to the purple line. The purple line is going to start trending and look closer to what the green bars look like. So this is getting closer and closer to expiration. Getting really close here. And then right at expiration, they line up with each other. This is the day before. This is the day of. So let's go back a little bit. So if we go to today's expiration again on May the 5th, you notice that you could be negative if it drops a lot right away. If we go about a week later, the curve starts to head a little bit upward, but you're still negative if it drops at first. If we go out another week, these lines are starting to trend towards the green. Your break even would be even lower, around 39.70 or so. Near the end of May, your break even is pretty close to 38.72. And the reason why this is happening is your put debit spread is starting to be worth a little bit more if it happens to be in this green bars. Okay. And then if we go near middle of June, again, you're increasing your possible profit ranges. Right here, break even's about 36.70 or so. Notice how this purple line is always positive afterwards at higher strike prices. And then as you get to the expiration, you'll follow that green line. Okay. Now, one of the main strategies that you could do for this trade is when do you want to exit it? You might want to take profits a little bit early. So maybe in the end of May or so, if MES happens to be at 3,900 or so, you could decide to sell the put debit spread for a profit. Remember, we bought the put debit spread for 10 times the 5 multiples, $50. That would be able to get sold for more than $50. Could be about $80, $90. So you could profit there. And you could keep your short MES put that's still very far out of the money. Another neat one that I like to do is, let's say it's around here. Let's say MES is pretty much flat. It's still around the 4200s or so. You could possibly buy back this sold naked put at the 35.50 and ideally pay about $10 for it. So remember, we're making about at the 35.50 about $22 or so. If we could buy this back at 10 or 12.25, then suddenly this put debit spread was actually paid for already, and you could just leave that on as a hedge in case MES happens to drop afterwards. So it's essentially a free trade at that point. Again, if you could buy back just the 35.50 for 10 less than what you sold it at say 22.25. So again, if you could buy it at 12.25, maybe a little bit less for commissions, around 11.50 or so, you can just leave this on, and then you have a hedge against a downturn. Later on, if it gets near expiration and we're lower than 4,000 on the strike price, you could then decide to sell that put debit spread for a pretty significant profit, and you took all your risk off the table. That's one of the main ways I like to do these trades, if I could essentially have a free trade. Sometimes I like to let it go even more than 10 down on the naked and maybe buy this back for say 4 or 5. And then I have this trade not only for free because I got a net credit that paid for that put debit spread, but I would still have a little bit of a credit in the end in case MES just rises up. All right, so that's some of the basics of the 111 trade for MES. I definitely like the lower break even. I like having that little hedge there in case S&P or the futures market happens to drop a little bit, not necessarily a ton. So I don't feel as stressed out if you're having to necessarily close that out. Maybe you could profit on the put debit spread side. And also, your margin requirements actually aren't necessarily as dramatic as just a naked put because you have that put debit spread that helps increase our profits if it drops a little bit. One of the deficiencies to this is the commissions are relatively high because you have to do more contracts than just simply selling a naked put. So again, I'm the investing teacher, high school science teacher teaching others how to invest. If this might be interested in learning strategies like this and others, consider joining thetatraders.com. There's a link in the description down below. Feel free to ask me any questions in the comments below, and happy trading.